Hey everyone, Kelly here. I'm going to walk through how to build a DCF or discounted cash flow model in DeciPad. And I'm going to use Apple as the example today. Apple is one of the most valuable companies in the world. Its market cap is currently a little over 2.6 trillion. So it's a really fun example to work with because Apple has a lot of free cash. So what we're going to see is with small changes to interest rates, which are core input into a DCF, how much Apple's underlying share value can really fluctuate. And if you're new to DCF, it's just a way to value a company by making some assumptions about its future cash flows and then discounting that back to the present. And today I'm going to walk through how to build a DCF model. This is not financial advice. All right, I'm going to break down this model into 5 steps. So let me give you a quick overview of that, and then we'll go through each step in detail. So first, we're going to want to forecast Apple's future cash flows. And this is where you're going to see a lot of variation from one person's model to the next because there are different ways to make predictions about the future. Then we're going to calculate a terminal value. And this is just a way for us to get a more complete picture of Apple's overall value beyond our forecast period from step 1. Step 3, we are going to discount that future cash flow and terminal value back to the present using an interest rate because money in the future is worth less today. Then we're going to estimate our market value and value per share of Apple based on the assumptions we've made in the model. And then finally, we can compare that to Apple's actual share price and then just explore different scenarios around the assumptions that we've made. All right, let me jump back in and let's walk through each of these steps. All right, we're back in DeciPad, so let's get started. So first, we're going to forecast future free cash. And there are a lot of ways we can do this. I'm going to look at some historical data and then make some assumptions about the future. And I've already pulled in that historical data. I created a table here, but you can add data to your notebook. You just use the / command, and you can add different types of blocks, like a table, a formula, visualizations to start building your model. And I've pulled in some key metrics like revenue, EBITDA, and CapEx, and pulled most of that from Seeking Alpha. And you might notice in here, I have a mix of billions and millions. DeciPad is completely unit aware, so you can pull data from different sources, and we're going to convert that for you. You don't have to worry about doing smaller calculations to convert, and it just reduces errors. I've also added a couple of formulas on top of this table, calculating free cash and looking at certain drivers of free cash like EBITDA margin. And you can see those formulas up here. All right. And any table that you create or import into DeciPad, you can create a chart by just clicking this here, selecting the chart that you want. I created a small chart down here, just nice to have a visualization. And if we look at the last 5 years, the last 2 years have been pretty impressive performance in terms of revenue, and free cash has also grown fairly significantly over these last few years. So I'm going to make some just general assumptions about the future. So looking at things like EBITDA margin, I'm going to just say that there is no growth in Apple's future free cash, meaning it's going to stay in line with sort of these post-pandemic levels. And to represent that in my notebook, I'm just going to take an average of the last 2 years and use that as my forward-looking projection. And you can add any calculation to your notebook by just hitting equals, and you're going to get this block that pops up. I've already calculated this average by taking the historical table and asking for an average of every year after 2020. So now what we're going to want to do is forecast that assumption out. And I'm going to forecast it out 5 years. Now, Apple's a pretty steady state business, so I think that would be a reasonable time period. So I'm going to create another table. Let's call this forecast year. Look at free cash flows. Also look at EBITDA just so we have it. And I'll make this a series for speed. And we're assuming no growth. So I can do a pretty simple formula. I'm just going to say future free cash is equal to our variable up here. So I'm going to select it from autocomplete. And I could do the same with EBITDA. But I do want to add in a growth multiple so that I can play with different scenarios. So I'm going to add a widget, use the slider. We'll call this growth. And we're assuming 0%. And I'm just going to add this variable here. And what's nice in DeciPad with our language, you can just add growth, and it assumes you want to add that onto your previous variable. So now if we were to play with this, we would look at what is that forecast if there was some growth. Now this is just applying a steady state. What I might want to do is apply it year over year. So I'm going to put previous here. Now it's going to apply that growth on top of the previous year. All right, so let's default this back to 0, our assumption, and we've completed step 1 in forecasting Apple's future free cash, assuming no growth, and we've done a forecast out for 5 years. Now let's take a look at calculating the terminal value. Terminal value is just a way for us to get a more complete picture of a company's overall value beyond the explicit forecast period that we just looked at in step 1. And there are different ways to calculate terminal value. One common approach is to assume that a company's future cash flows stay constant beyond our projection period. And this is called the perpetuity method. And we can calculate that by first making an assumption around interest rates or a discount rate. And this is going to be a major input or assumption into our model. So let's say a discount rate assumption of 3.4%, which is close to the 10-year US Treasury. And to calculate terminal value, it's a fairly simple calculation to make an estimate here. We're just going to take our future cash flow estimate and divide it by that discount rate. And we could play with different discount rates to see the effect. And maybe we want to drag this into our model to create a more connected story. We could also drag things from our sidebar, which is just a summary of our key inputs and results. I'm going to drag that here. So now that we have our future free cash forecast and our terminal value, what we're going to do next is discount both of those back to the present. So we're going to look at the present value of future free cash and the present value of our terminal value. So first, let's look at the present value of future free cash. And let's call this PVFC. And we have a function in DeciPad for calculating net present value, or you could calculate it manually, but I'm just going to pull that up, called MPV. And you have to tell it 2 inputs. So one, the discount rate, and then the series that you want to discount over. So we're just going to type in our discount rate, which is, we're going to use that same rate of 3.4%. And then we're going to forecast that over our free cash flow forecast, which is just going to be this column. We said free cash flows isn't going to change. So I'm going to plug that into this function, and I'm going to take my 5-year forecast and take the free cash flows column. And that's going to give us a net present value result of 416 billion. So now we need to calculate our present value of the terminal value. We're going to use that same MPV function. We're going to add a discount rate, and now the terminal value, remember, it's calculating in perpetuity beyond the forecast period. So for that series, I'm going to give it 0 for the first 4 years, and then I'm going to plug in the terminal value that we had up here, which is 2.7 trillion. And you can see, the result is 2.29 trillion, so a little bit discounted from our future terminal value. All right, so we have now discounted everything back to the present. So now we can calculate our value per share. We have our last step, and this is the fun part. We're going to estimate the value per share based on some of the assumptions that we've made. So first, what we need to do is calculate Apple's enterprise value. So let's call this ent value, and that's just going to be the present. You can add emojis to your calculations, but I don't need that now. The present value of future free cash plus the present value of terminal value. Now, the enterprise value is, like if you own a home, the full value of that home. But now we want to calculate the market value because we're trying to estimate the value per share. And to do that, first we need to look at net debt because the market value is going to be your enterprise value less your debt. So if we look at, let's go over into Seeking Alpha, we'll go into Apple's balance sheet and grab net debt. All right, so last reported 54,340, and everything in Seeking Alpha is in millions. And it was negative, so they have negative debt. All right, so now let's calculate market value, which is just going to be that enterprise value less net debt. And because its debt is negative, its market value is actually higher than its enterprise value. So in that example, if you own a home, usually you would take out your debt to calculate your market value or equity. All right, and the last step that we're going to do is we want to calculate value per share. So we need one other metric, which is Apple's total shares outstanding. And we can also get that from the balance sheet. So common shares outstanding, 15,842. And those are all in millions, which is really billions. All right, so we have our shares outstanding. And finally, the value per share is just going to be that market value divided by our shares outstanding. And it's $174 per share is what we are currently estimating based on the inputs in our notebook. And let me drag this up here. All right, so last thing we want to do is let's explore some scenarios. All right, so we have two assumptions that we've made here. One, that the discount rate is on par with the 10-year Treasury, which is currently about 3.35%. I've actually pulled in some live data down here, so I'm going to update this 3.35%. And we've assumed no growth in future free cash. And we could obviously play with different scenarios. And I'm going to create, let me show you from scratch. I'm going to create a result widget. I'll drag this over here. And I'm going to pull in our value per share so we can compare it to this actual share price. So as you're going to see, if we even move interest rates slightly, our value per share fluctuates quite a bit. So it went from that, about 164 if we put it at 3.6, if we put it down 174 where we had it originally. And as interest rates go down, the value per share is going to go up. We could also play with different scenarios if we think cash is going to grow, and we can obviously compare that to the actual share price. Now, there's a lot coming soon in terms of live integrations of your data into DeciPad, but right now you can pull in data live from a Google Sheet. So I've kind of set up a Google Finance live query, and all you do is you copy this URL and you just paste it into your notebook, and you're going to say connect to Google Sheets, and it kind of creates a live connection of that data point. Now I already did this here, so just showing you how that was done. All right, and that's it. Now you have a pretty dynamic model. I will share this. It's really easy to add additional assumptions on top of this, go back and revisit it, and just play with different circumstances. So I hope this is helpful. Let me know if you have any questions or any thoughts on how to make this better.